From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, Fed officials teeing up a faster taper, European lockdown shaking up the ECB, heading into a big month of central bank calls. We begin with the big issue, one obsession, zero consensus.
Inflation.
Getting to the inflation conversation.
We're starting to split hairs over exactly what transitory means.
We talk a lot using words like transitory.
Transitory.
Not transitory.
Persistent.
It's been long enough.
Camp transitory is getting smaller.
This word transitory has been dissected far too much.
What's the Fed going to do about it?
The problem that we have with inflation now needs to be dealt with succinctly.
We've seen higher than expected, higher than consensus inflation.
We could see a situation where inflation continues to be entrenched.
Joining us now to discuss is Columbia Threadneedle's Tannuzzo, TD's Priya Misra, and Zach Griffiths of Wells Fargo. Priya, we've got to start with you. The range on the Federal Reserve right now, we've got Goldman going in July. We've got you all the way out in December 2023. That's in the TD outlook. Priya, how comfortable are you with that outlook right now?
Well, it is in line with our economic forecast, where we have growth slowing because of the fiscal drag next year. And we have inflation also peaking early next year and then decelerating. I mean, our view is that we're far from maximum employment. So the Fed is going to let the economy run hot, try and bring people back into the labor market. And therefore, they'll only hike late 23. I have to say risks are to an earlier hike, but that ultimately is going to come down to the economic outlook. I think it's less about the Fed reaction function. I think it's much more about the economic outlook. And, has the labor market structurally changed where these people who've left never come back? I think it's going to come back to that.
We've got to work through the taper as well, the taper story. Will that be accelerated? In the last hour, Vice Chair Rich Clarida had this to say, may be appropriate to discuss the taper pace in December. And then these comments came just after Governor Waller said this.
The rapid improvement in the labor market and the deteriorating inflation data have pushed me towards favoring a faster pace of tapering and more rapid removal of accommodation in 2022.
Zach, are we inching towards a quicker taper at the Federal Reserve?
Certainly some firm words there from Mr. Waller, but we don't expect the taper to get accelerated in December. It feels like a little bit of a hasty move at this point, and perhaps they can discuss it and outline that discussion, and we'll learn more about it in the minutes. But we'd be very surprised if they accelerate the taper at this point. They probably want to see more data, and it's really going to come down to what happens with the labor market over the next couple months, and we still think they probably want to see more labor market data before making that decision.
Gene, it's very difficult to get a read on all of this. Vice Chair Clarida could well be leaving. We expect him to be gone next year. He's talking about debating it. He's not calling for it. There's a difference there, isn't there, Gene? I'm struggling to get a read on all of this going into December. Are you?
Well, look, I think we need to remember that this policy was put in place about 2 weeks ago. So I think it's very unlikely that we get a change to that policy in December. But they're trying to remind us something that they always talk about, which is that policy is not on a preset course. And how better to communicate that policy is not on a preset course than to make sure that we're keeping the market abreast to things that could change that dynamic. And so I think we're going to hear a lot of voices on this topic, but I still think in December, it's unlikely that we get a new pace of reduction from this sort of 15 billion that we're starting with here in November.
The reason I'm struggling to read this, and Gene, Priya, I'd love your view on this too. This came from Neil Dutter of Renaissance Macro, following all these comments from Vice Chair Clarida, from Governor Waller. He said the following out on Twitter. Hawkish comments from Governor Waller and Vice Chair Clarida underscore the need for the Biden administration to start naming candidates to the Board of Governors. They can push the Fed's reaction function in a more dovish direction if they choose to do so. Priya, that's where this is missing right now. We're going through a really key phase, an inflection point for policy, and I don't understand the leadership beyond next year, beyond early next year. Do you? And is that important?
It is extremely important, right? Because it's the economic outlook and it's the Fed reaction function. And if you don't know the chair, you don't know the two vice chairs, an additional spot at the board, I think that is adding to the uncertainty. And so markets are trying to price in both uncertainty on the economic outlook as well as the Fed reaction function. How nervous are they about inflation? And the SEP, the September dot plot, showed that there's a clear divide at the Fed, where those that are worried about inflation want to hike sooner versus those that want to wait. So I think if you have 3, 4 new people or a movement there, it can absolutely move the median dot. It can move the conversation at the Fed. It can affect this pace of taper. I do want to flag that this tapering pace is already faster than the last taper. I think the Fed has responded to the inflation risk. Maybe it's more risk management than their base case view. They started it earlier than what anyone thought. They started tapering earlier. They were already tapering faster. And so, I think they've already responded. Is there a need for them to respond again? So back to your, I guess, earlier question, I think that the threshold to make the change in December is very high. Should they start talking about it? Sure. But actually taking that step, especially with the changes at the Fed leadership and at the board, I think it's much too early to be talking about that change.
A bit of additional guidance coming out of the White House. The press secretary, Jen Psaki, holding the daily news conference, saying we will have more to report on the Fed early next week. We wait, and that date seems to keep changing around. Gene, you and I have caught up recently, and we talked about this odd disconnect in this bond market. I hear a lot of people saying that maybe we have to go quicker on rates, but still they look at a very, very shallow rate path. What's the disconnect that you've identified, Gene, that you think we need to pay some attention to?
Yeah, I think that's the critical piece, John, is that the market seems to be saying, look, inflation's a problem. The Fed needs to get started hiking. And the market's actually pricing hikes before the Fed is forecasting them. But the market's also pricing in the Fed stopping their hiking cycle at about 1.5 to 1 3/4, which is well short of where the Fed thinks it will go. I think that's a very narrow, very unlikely scenario. And I think what's more likely is as we get confidence in this recovery and we transition really from a recovery to a traditional expansion, which I think we've yet to do, that the market will react to that. And what we'll see is the market pricing in a higher terminal funds rate, probably something closer to 2.5% or maybe slightly higher.
I heard from the former New York Fed President Bill Dudley earlier this week, and this is what he had to say on the prospect for that rate going a whole lot higher. Take a listen.
The market expects the peak in short-term interest rates for the federal funds rate to be around 1 3/4%. 1 3/4% peak in the federal funds rate in this business cycle will be the lowest peak ever.
Does that have a 3-handle, Bill? Just to squeeze that question in. What kind of numbers are you thinking about? Yeah,
probably 3 to 4. Yeah. That's what I would,
well,
obviously the crystal ball is cloudy as you get further out.
There we go. Fed speak.
3 to 4. Zach, can you weigh in on that? Not just the start time, the end point. When I heard that earlier this week, I have to admit I stepped back a little bit, almost fell off the chair. 3 to 4, Zach. Do you think we can achieve those kind of levels on the Fed funds rate?
3 to 4 seems a little high to us, John, but we do think something in the 2 to 3 area, probably the low end of that range, is realistic. And if you think that inflation is going to be higher in this economic expansion than it's been in the past, then you're going to need a higher nominal policy rate to really achieve the same kind of real terminal rate. So that's something that we've been considering, and we'd agree that the market is pricing too low of a terminal rate at this point, and perhaps if the Fed were to continue to suggest it could accelerate the pace of taper, maybe the market starts to reevaluate that, and that could get a boost. But yeah, we think that 3 to 4% is too high, 1.5 to 1 3/4 is too low. So we think something in between there is probably more realistic.
Priya, you've got a late start. I understand that. The back end of 2023. And to really ask you where this could be going, I think that's real crystal ball type stuff. If you think we start in December 23, it's a long way off for when the Fed funds peaks. But how do you think about that at the moment, the limits of how far they could push interest rates?
Sure. So we are also in Zach's camp, sort of 2 to 3. I'm probably closer to 2% than 3%, but 2.5. They ended the last cycle at 2.5. I think what the market's doing is really pricing in what we've been debating, the bimodal distribution. Do they start early, and because of that, they have to slow things down, much earlier, and therefore they can't have a full hiking cycle? Versus the scenario where they start a bit late, they let the economy run hot, and then they may have to go above neutral. I think the market's pricing in both these sort of bimodal aspects of this distribution, which is why we're sort of pricing in this early start, but a shallow, very shallow hiking cycle. I mean, I do come down, it ultimately is going to come down to real rate. Where is the equilibrium, what we call R star, real equilibrium rate, and inflation. Now, I think some of the structural disinflationary forces are still very much at play, whether it's globalization or technology. So to see long-run inflation expectations above 2% is tricky. It's going to come down to R star. Has productivity picked up to the point where the economy can handle 3 to 4% rates that Bill was talking about? I really struggle with that. So I think the moment they start to raise rates, and the other thing I want to highlight, there's going to be quantitative tightening. At some point, the Fed's going to raise rates to 1.5, and I think then they're going to let the portfolio run off. That's a lot of treasuries that the private market will have to take down. Long end rates will rise. So there are other ways the Fed's going to be tightening as well. They won't necessarily need to take the funds rate that high. Quantitative tightening will also kick in to tighten financial conditions.
Jean, have you been surprised by how much flattening we've seen in the yield curve, considering how deeply negative we have the Fed funds rate right now in terms of real terms, deeply negative in real terms, negative 6 percentage points or so, and yet we haven't had that steepness come through the curve? Jean, I just wonder how you react to that.
Yeah, I think there are some near-term factors that might be driving that in terms of demand for safe haven assets and what we're seeing, frankly, elsewhere in the world. And there is still sort of this U.S. growth dynamism story, but there's also the fact that it's the highest long-end yields in developed markets for the most part. But I think as we get sort of beyond this year, I think the fact that Priya raises a very good point. There was a very interesting paper that came out of the Kansas City Fed recently, really justifying this idea that at some stage in the tightening cycle, the Fed ought to be actively letting its balance sheet run off, or maybe even selling long-run securities as a way to tighten financial conditions rather than just raising the Fed funds rate. I do think that in time ends up in a steeper yield curve and higher 10 and 30-year yields.
Zach, just a final word on that, if you can.
Yeah, we'd expect the balance sheet runoff to take place a little bit further down the road than I think others are considering at this point. And it's going to come down to the fact that it didn't go that well last time. You had the September 2019 blow up. I think that's pretty fresh in people's minds, even though there's been a lot to deal with since then. So we think that the balance sheet runoff is probably a further out prospect than something in the next couple of years.
Zach Griffiths sticking with us alongside Priya Misra and Jean Tannuzzo. Coming up on the programme, up next, the auction block. Demand for junk remaining hot with borrowers of all stripes rushing to market. That conversation just around a corner from New York. This is Bloomberg. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction blog, where we kick things off over in Europe with a resurgence in virus cases sapping the mood in primary markets, setting the stage for the first zero sales Friday since August. High-grade issuance in the US also stalling out on this Friday, but not before 39 issuers came to market, raising close to 60 billion, and still no signs of slowing demand for new junk bonds, surpassing dealer estimates after raising close to 30 billion this month. A bit of news out in the last couple of minutes, a high-profile case taking place here in the United States. The result of that case, Kyle Rittenhouse acquitted of all charges in the Kenosha shootings. That headline just dropping across the Bloomberg. Kyle Rittenhouse acquitted of all charges in the Kenosha shootings. That headline out just moments ago. We'll continue the coverage on Bloomberg TV and on Bloomberg Radio on that through the day. Turning to Europe, where the lockdowns are back. MUFG's Derek Halpenny saying the ECB has an excuse for being behind the curve.
If there's any central bank that has credence or credibility in terms of its guidance of being towards the back of the queue in terms of rate hikes, it's the ECB that has a good, solid, fundamental reason for being much more delayed in tightening. And I think that has further to go. On top of that, what's happening with COVID, then I think you could get another kind of readjustment.
Let's bring back in the team. Jean Tannuzzo, Priya Misra, Zach Griffiths. Priya, I want your view on this. How much things have changed now for the ECB going into next month?
So, I think the whole COVID case surge is another reminder. The pandemic is not exactly over. Plus, for the ECB, they have sort of suggested that the PEP program, the emergency PEP program, is going to end. The APP program is still ongoing. In fact, we think in December, they're going to increase that APP program. So the ECB that has their new framework in place, I think they want to really separate out the end of PEP from the first rate hike. They don't have as much of that inflation fear. Now they've got the COVID downside risk as well. So we think they are going to suggest being well behind the curve in terms of inflation, in terms of when they're going to hike, while they're ending PEP. So we do think they're going to end PEP. They've already sort of telegraphed that, but extend APP and talk about being on hold for quite some time.
The clue in PEP is the E. the emergency and pandemic emergency purchase program. And Gene, to Priya's point, it may well end, but ultimately they can carry that flexibility over. Don't they have the excuse to do that now, Gene?
I think they do have the excuse, particularly if a large portion of the continent is locking down again. And I think that's the sort of the key factor here. And frankly, the ECB is probably going to be the last in this sequence of developed market central banks to really move towards tighter policy. I mean, I think the moves on the Bank of England side are ones to watch, frankly, if we see them actually raising rates before even asset purchases are complete.
Can I have your view on this, Zach?
Yeah, certainly an interesting dynamic going on in Europe, and the COVID case counts. I'd say the move today has been a reminder, like Priya highlighted, that we're not through the pandemic, and that could remain an issue. So I think that definitely argues for the ECB to remain patient, and that's kind of been our view all along. We tend to joke on will they ever be able to raise rates, and we do think they will eventually, but there are a lot of steps in between here and that point, and I think it does start with the elimination of the PEP program next year, but we do think asset purchases are set to persist for some time, so these rate hikes are not going to happen for a while, and I'd say the latest developments probably push that out even a little bit further.
Gene Tannuzzo, Priya Misra, Zach Griffiths, sticking with us. Still ahead, the final spread, the week ahead featuring US GDP and the FOMC minutes. That conversation coming up shortly. You've been looking at live pictures from a courthouse following Kyle Rittenhouse, the result from that court case, acquitted of all charges in the Kenosha shootings. From New York, this is Bloomberg. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread, the week ahead. Coming up, we remain on the lookout for President Biden's Fed share announcement. Eurozone and US PMIs coming up on Tuesday. US GDP and the FOMC minutes headlining a busy Wednesday. And finally, US markets closing out on Thursday for the Thanksgiving holiday. Looking ahead to a really key month of December. The middle of December, a Federal Reserve decision, an ECB decision, and a Bank of England decision too. Priya, it's all coming together. This year's all going to end in about 24 hours, within 24 hours in the middle of December. How key are those 2 days for you?
Important. We get the dot plot as well for the Fed. But I don't think at all we're going to have that many answers. I mean, from the ECB, I think, yes, they'll extend APP. They'll talk about hikes being later. The Fed, we don't think they're going to accelerate taper. So I don't know if we'll get that one. Those are very important meetings. Where I think it's very important is liquidity conditions have already started to worsen, and we're going into year end. So I think the markets could react a lot. I'm not sure we'll get that much more fundamental data, from payrolls or from all the central bank meetings.
Zach, what about you? Is that a key part of the year for you, the way we end set up for next year? Is it just too early to really get any clarity, any vision on what 22 looks like?
I think it's a huge part of the year, certainly for the outlook, but also in the near term. Another thing that might be flying a little bit under the radar is the debt ceiling episode comes back. Secretary Yellen said December 15th is the new X date, so that's the same day as the Fed meeting, and that's another factor that we consider when is it possible for the Fed to accelerate the taper if the debt ceiling is looking rocky as it was back in October. We think at this point that's probably going to be the situation again, and as Priya highlighted, we've already seen liquidity deteriorate a bit. It probably gets a little bit worse into year end as people take holiday and the markets just aren't as active. So I think that creates a difficult backdrop for accelerating the taper. And outside of that, yeah, we'll be watching the non-farm payrolls number, the CPI prints, but I think as far as those two numbers really changing the Fed's thinking for the December 15th meeting, I think it's more going to be a part of the bigger picture as they look into what type of policy moves they need to make in 2022.
Gene, Zach turned to the situation in Washington, D.C., the fiscal effort, the debt ceiling debate. We're going to have it all over again over the next month or so. When we move on from that into next year, I hear from a lot of people in fixed income who talk about fiscal drag, who talk about supply actually meeting what's happening with the taper, the twin taper, the Treasury pulls back at the same time the Federal Reserve pulls back. And Gene, for a lot of people outside of that world, that's a foreign concept to them. They see so much happening down in Washington. The idea of a fiscal drag and twin tapering doesn't really stack up. Is that what you expect next year?
We do expect that next year, but it's almost inevitable, right? Because we saw unprecedented fiscal policy in response to an unprecedented pandemic. We saw almost 25% of GDP spent in a very short period of time. But by definition, that will not be sustained, and that will become a drag. I think that's okay, though. And I think, again, this economy is still trying to find its trend. We are still growing well above trend. We are still in sort of this recovery rather than the expansion. And I think case in point is the labor market data. In the last 6 months, we've added almost 700,000 jobs per month. The trend in a full employment economy is probably 150 to 200,000. So I think a lot of this data, frankly, can't be relied upon at this stage because we're still in a very volatile period.
Let's get to the rapid fire round, guys. 3 quick questions, 3 quick answers if we can. And let's start with this one. Chairman Powell or Governor Brainerd for Fed Chair? Chairman Powell or Governor Brainerd? Priya?
Governor Brainerd.
Gene?
Brainerd.
Zach?
Powell.
Interesting. I'm surprised 2 went with Governor Brainerd. That's interesting how things are changing, developing over the last couple of weeks. Next year, I know where Priya is on this, 0 hikes next year, 1, 2 or more. 0, 1, 2 or more. Gene?
I think 2 is most likely next year.
Zach?
2.
Drum roll. Priya Misra, I know where you're going. Go on, Priya.
0.
0. They're looking for December 2023. And final question for all 3 of you, if I can. December 15th, the Federal Reserve. A day later, on December 16th, we'll hear from the ECB and the Bank of England too. If you could pick one, just pick one that you want to know the result to, the news conference, the whole lot ahead of time, which one would it be? The ECB, the BOE, or the Federal Reserve? Priya?
The BOE.
Zach?
BOE.
Gene?
That's got to be the Fed. I mean, these other ones are sideshows.
I'm surprised that those 2 went with the Bank of England. I'm surprised by that. Guys, good to catch up. Gene Tannuzzo, Priya Misra, Zach Griffiths from New York City for our audience worldwide. That's it for me. This was Bloomberg Real Yield. For our audience worldwide, this is Bloomberg.